the risk about being out of the equity game is huge compared to being in.
Yep.
What circumstances are making you say that?
That was a comment or a quote done by Warren Buffett some years ago, and I think he's spot on, because investors, and I think it's not relevant whether they are institutional or private, always focus on the short-term risk and underestimate the long-term return possibilities, which I would argue equity markets have proven to fulfill and will prove to fulfill in the future. Yes, you have from time to time market behaviors triggered by political or economic reasons which make investors nervous. I think what we have seen in February and March are perfect examples for that. But then you have to sit down, just try to get the emotions out of your brain and make the calculation. And the basic calculation, I would argue, is that interest rates are more or less zero, that we have a global economy which is still growing. And if you bring these two functions together, well, then I think it's quite realistic to assume that equity markets will be able, and I would argue as one of the few asset classes, to beat inflation in the future.
What general personal money management advice would you give to people in the present macro environment?
It's the same I would have given to them 10 or 20 years ago. Just spend a weekend by evaluating what is the amount of money you are able to invest for how much time. Mm-hmm. Again, during that weekend, try to formulate your yield expectation, and based upon that, build an asset allocation which enables you to achieve that yield expectation after cost and taxes, invest, and go on holiday. I would argue, and maybe that's something which is not the best news for you as a magazine, that private investors just spend far too much time about trying to time the markets and to pick the right corporations. I always use as example the portfolio investment strategy of my mother. My mother is 18 years old, so 80 years old. She has a very easy inflation beating target. So she wants, after cost and taxes, achieve at least 2% annual return, which means gross she has to achieve around 4% of return. So my mother has a portfolio of 55% equities, of 10% physical gold. And the remainder is just an allocation between cash and corporate bonds, depending on the individual risk and reward. And she is not going to change this asset allocation over the year. Typically, beginning of January, after the statement of the portfolio, the annual statement is sent to her. She calls me up and said, "Philip, do I have to change anything?" And then typically she emails me her portfolio statement. There are some minor reallocations, and then the portfolio is again sleeping for the next 12 months. My mother has a decent track record and has been able to beat inflation over the course of the last 20 years. I think that's certainly something which would help a lot of investors to do the same. For me personally, as you can imagine, we have very strict compliance rules. Since I'm operational active with Flossbach von Storch, and that's for the last 11 years. I have not produced one single sell ticket. They only know buy tickets from my side. And that gives you a clear idea that A, I'm not a trader, and B, that I'm still very confident that equity markets are by far the most attractive investment.
If you were to segment individual investors to various different types, based on age or based on annual personal salary, how would you do that? How much and how much different investment strategies would you recommend for them?
I think it's very easy. You don't have to differentiate between annual income or wealth.
Mm-hmm.
The only factor you have to keep in account is the amount of years
Mm-hmm.
you can invest the money. I always argue if the time span of your investment is shorter than 5 years, then it's only cash, full stop. You have to live with being caught in cash investment, because if you only have 5 years, the risk of just sitting in a period of poor equity performance is real. If you have a period above 10 years, my allocation would be 100% equities.
Mm-hmm.
And the range between is just an increasing equity portion by 20% for every year. So 6 year means 20, 9 year means 80% equities. That's simple, but I think the simpleness of an investment strategy is one which helps people most.
Mm-hmm. But in the present environment where the inflation expectations are sort of mildly rising or on the horizon somewhere, and the interest rates remaining around zero, that means that that holding fiat money means losing its value, right?
That's absolutely right. It's
So,
losing real value.
How does this go together with, for example, 5-year being only in cash?
Yeah, it's just a risk-reward process. The risk of being hurt by a negative market move is just too high if you only have a 5-year investment horizon to position yourself. That's bad luck.
Okay.
But if you only have 5 years to invest, you have to stick with cash and can't afford taking the risk of equities.
That means that coming back to sort of expected zero wealth is, I imagine, investing about 6-7 years.
If you are investing 6 to 7 years, it rather would be a balanced account, a 50-50. But I would argue most investors have quite a huge amount of their wealth which implicitly has an investment horizon of 10 years. Yes, there are some people who exactly know today that they need a good portion of their wealth for building a home or something like that.
Yeah.
But people like you and me, who have no fixed cash drain moment in the next 4 or 5 years, our money will be more or less free for investing until retirement. At least if you have an age until 40 to 45, people are always underestimating their positive cash flow.
What does that mean?
The typical case is that you invest in a way. You have a fortune right now. If you are 30 and you have an income of, let's argue, 25,000 euros a year, then your investment behavior is based upon this 25,000. If you are a trained person, your income is going to rise with your level of traineeship, with your level of experience from 25 to 40, and you already should realize that you should take more risk today than the 25,000 are implicitly arguing. If you are somebody sitting at the counter in a supermarket, this certainly is not true. But for people who are well trained, well educated, that's clearly the philosophy which they should keep in mind.
How paranoid do we need to be about inflation outlook? I have come across a hypothesis that quantitative easing has virtually no effect on inflation. Do you think that is correct?
In principle, I would argue it is correct. Inflation only is going to spill over into the real economy if people receive an enormous one-time payment, so helicopter money, for example, or if they are really getting nervous about the capacity of fiat money to store value. I would argue that's not yet the case with the broader public, and we still have no helicopter money. So I would argue that it's highly unlikely that central banks will reach their new inflation targets without adding very creative instruments to their central bank policy. So I'm not very nervous about inflation, but inflation wouldn't be a bad thing for all kind of real assets. So if you are afraid about inflation and you have a longer investment horizon than 5 years, I think it's an absolute must to invest in real assets in your own home, which I always argue is the start of building a personal wealth. But if you have your own home, then the next step is obviously global equities.
What are how afraid are you about the inventiveness of central bank policies?
I'm not necessarily afraid.
There is talk about, you know, creating digital currency, about universal income, and
I fully understand that
idea.
there are two functions to that: being afraid as a citizen who is nervous about the structure of our economic system. Yes, I'm very afraid, but being afraid as an investor is a total different issue, because central banks, which are very creative, are going to destroy the trust of people in the monetary system, in our capitalistic economic system. Yes, they do. But every instrument they are using certainly is going to propel, at least on relative terms, the attractiveness of real assets versus nominal assets. Those who really should be nervous about creativeness of central banks are those holding enormous amounts of their wealth in nominal assets.
So in the environment where investors are and will continue to be losing money holding fiat currencies, and holding low-risk bonds. Investing in large cap shares seem to be a proper conservative approach to investing. Is this like the new conservative game for the next 5 to 10 years?
I think first of all, I disagree that most people realize they are losing money. Because most of the public still lives with the so-called nominal illusion.
Exactly.
100 euros stays 100 euros, and they don't think in real values. But I think that may be changed over time, and then they are obviously looking for alternative to cash or to low risk investment. And I think it's not astonishing that people who are thinking along that line, they are looking for corporations with quite a stable income flow, with quite an uncyclical business model, and take these kind of corporations. Food supplier certainly is one of the sectors they are looking for as a substitute for cash or short-term fixed income investments. I agree.
We saw many articles in the recent months about small young investors who open their, I don't know, Robinhood accounts, and then they gamble the money away on the stocks that are popular at the moment. I observed a similar trend in the crypto era in 2017, when many young people open new cryptocurrency accounts. Do you think that there is a comparison between those two periods, or is this something new? Is this time different?
It's different, obviously, because this time they are opening accounts. And you're certainly referring to the so-called Robin Hood rallies. A lot of young people who maybe were a little bit bored during a Corona lockdown, opening an account and following fashion stocks like Nikola, and very small technology companies paying them up. Certainly, there is some truth to your argument that this maybe is not so sustainable. And you compare that to 2017 in the crypto universe. I think you have to distinguish. If you were I'm a crypto investor starting in 2015. I then was concentrating to the blue chip cryptocurrencies, especially Bitcoin. I bought Bitcoin around 205, and I still hold to these positions. And 2017 was just an episode which predominantly was negative for fashionable crypto coins. Bitcoin still trades above 10,000 US dollars these days, and the harm was not a lot. I think in general, it's positive that young people really think about investing in equities. We have to focus to the positive news first. And I'm an old fellow. I'm 58 years old, and my argument is always make your big mistakes in investing as soon as possible, because then you only have a very limited amount of money to lose. There is nothing more dangerous than making investment mistakes when you are old and don't have the cash flow or the time to recover. So in general, I take that as a positive news, and it's my daily job to motivate young people to think about capital markets and why on earth I should complain when they really do what I'm trying to convince them about. And I think it's the privilege of young people that they are not going to invest in a food supplying company, in a boring stock, but in an tech or very fashion truck producer stock because they like to be thrilled in one way or the other. That's the advantage of the youth. And they will burn their fingers, some of them at least. They will learn their lesson. They will develop their own learning curve. And that's certainly positive for their future investment life. So I'm not comparing the situation right now in the equity markets, the so-called Robin Hood rally, with the crypto world, because they are different players. The crypto players rather were tech freaks, very tech-affine people, whereas the Robin Hood people are just young people who have some time, who are bored to look YouTube videos or Netflix. And I think maybe it makes some sense to train a bit how to invest. So some fingers will be burned, I'm sure, but in general, I like the news, and I think they all will develop a very useful learning curve, which is improving the situation regarding private wealth, and which is also improving the general understanding of how a market economy is going to work.
With all the online investing tools, eToros and other apps, it seems like investing has never been easier. So are these times to be a non-expert solo player? Or would you, despite of that, recommend that lay people reach out to investment fund managers and go investing through them instead?
Look, I try to convince that people invest in global equities. That's my very first target. And I'm happy if people finally do so. If they think an MSCI World ETF is fine, why should I complain about that? They have done at least the most important step into the right direction. If they think, well, instead of investing into an MSCI World ETF, I rather take 4 or 5 high motivated, high skilled active managers, then obviously I'm even more pleased because I think on the long run that's going to reward them in a sensible way. But hey, if they really decide to move out of their cash or their fixed income investment into global MSCI ETFs, that's the very first step. What I really think is a big mistake is trying to pick 4, 5, 6, or 7 individual stocks, and by these small numbers of very naively researched equities trying to rebuild a market index or an actively managed portfolio. I think this is certainly going to end in tears. So rather they should invest into an ETF than trying to pick with their naive research capabilities an individual portfolio of stocks. Having a diversified portfolio, global portfolio, is certainly a good portion and the easiest and cheapest way to reduce risk to a level which is acceptable to a lot of people. And the second most important is the investment horizon. And again, that's not good news for your newspaper, but that's my real personal opinion. Don't read too much. Don't especially read too much about short-term political events. All the debates about how important the US election is going to be to investing, that's waste of time. It's
Okay.
waste of time if you really focus to the medium and long-term investment horizon.
Mm-hmm.
Maybe,
I fully understand your issues. I had been editor-in-chief of a German economic publication 30 years ago, and I understand your task and your needs, but as a long-term investor,
Mm-hmm.
it's not relevant whether
Mm-hmm.
Biden or Trump
Win.
is
Yeah.
the next president. Relevant
Mm-hmm.
is that interest rates stay at zero.
Mm-hmm.
That's really relevant. And
Mm-hmm.
if anything would change to that, this will lead to a dramatic reallocation of a portfolio.
Mm-hmm.
But I have really a hard time to imagine the interest rate world to change.
I recently read an article about leveraged ETFs. Would you say that this could be a good investment opportunity for young people? Because leveraged ETF means that your, let's say, your risk increases. You invest into the, let's say, S&P 500 firms
Yeah.
with leverage. And default for, let's say I'm 21 years old, and if I would be to hold this ETF for, let's say, 20 years, that could be a great investment opportunity. But is this something for a small time young investor?
Yeah. A good question, a very good question. I had been manager of the world's largest derivative fund 20 years ago. So I have a little bit of know-how about how to construct leverage products and portfolio. And the crucial question is about implied volatility. What are the costs for the leverage and the counterparty risk, which is equally important. Look, if you have a bright idea investing in such a product, and suddenly your counterpart is not existing any longer. And especially if you are thinking about an investment for the next 20 years, have you a clue which financial counterpart is still existing in 20 years' time? So the very first job is to check what is the medium-term economic outlook of my counterpart. If, for example, such a product would be issued by Amazon or Alibaba, I would argue, well, that risk is not too big. If such a product is issued by a bank, I would be a little bit more nervous. Well, you are debating about a leveraged call ETF. So maybe the risk of a bank to break under such a scenario is not as big as if you are thinking about the leverage put ETF. Here, certainly the counterparty risk would be something I terribly would try to avoid. So if you have done your research or based on the counterparty and you think the counterparty will stand for the next 20 years, then it's a question of implied volatility. What amount of implied volatility are you paying with the product? And my argument would be, if you are able to buy such a product with an implied volatility between 12, then on an historic average, it's attractive. If you have to pay more than 17, I would think it's too expensive. That's just my subjective numbers, which are just a function of my experience in the derivative market. But it's not only about taking a leverage product based on your idea. Well, I want to have more risk because I'm young and my cash flow streams are going to increase, which is a very smart and a very good idea. No, it's only also about the question, what do I have to pay for that? And interesting enough, most investors are not thinking along that line because they are not able to evaluate what are the costs of the product.
What would be an example of an aggressive portfolio for you, and what a conservative one?
Based on what investment horizon?
Let's say 20 years.
20 years, an aggressive one would be 100% equities, and conservative one would be 80% equities.
Uh-huh. Okay. And the other part would be gold and
no, I would argue if you have such a huge chunk of global equities, you have already a very well diversified store of value. The need for physical gold with such a portfolio is not too desperately high. Gold, in my view, is especially an important investment if you have still a huge amount of your wealth in nominal fiat money investments, because then you have no protection against the devaluation of the real value of your assets. For me, would be a 100% Slovenian government bond portfolio be a very risky investment, because you have no chance over a 20-year time horizon to achieve a real positive return. You have the guarantee to lose money. 20-year Slovenian bond most probably is trading slightly above zero.
Yeah.
To be honest, I don't have the numbers in my mind, but I assume the 20-year Slovenia is shy above the zero line. But after costs, you will have a negative return nominal, as and real. It would be, I argue, you will lose half of your real value. Wow. Yeah, if you just take assume that inflation will be around 2%, 2 to 3% over time, then 20 years bites quite a bit. I can give me a second. I take the calculator. 1.00 times 20. Yeah. It's 48%.
Okay.
So it's close to 50%.
Yeah, but you mentioned gold.
And the interesting is people define risk always by volatility. And I think volatility is absolutely no instrument to measure risk. Risk is to lose your wealth over time. That's the risk. And I have a hard time to imagine that the 100% well-diversified global equity portfolio in 20 years' time, including dividends, will be worth less than today. Gold for us is ultimate money. If all the fiat money systems break apart, which I think is something which could happen during my lifetime. And that's not a negative comment regarding the euro. The same can happen to the US dollar as well. Then gold will be the ultimate money. And gold fulfills a function as hedging inflation away. So gold on a medium to longer time horizon is just storing the real value of your wealth, not more, but also not less.
Mm-hmm.
And you can imagine we would be very happy if in 10 years' time gold would trading around actual price levels, because then we wouldn't have had the financial and currency crisis.
Mm-hmm.
And we three and our citizens would be much more happy camper if it's not going to happen than if it's going to happen.
Mm-hmm.
So something between 5 and 10%, that's the allocation depending on the amount of real assets
Mm-hmm.
we recommend to our clients. And we all hope that this 5 to 10% is not going to perform,
Mm-hmm.
because then the rest of our portfolio is doing quite decent. The S&P 500 over the course of the last 90 years is only up.
Mhm.
It's only up. And the S&P 500 is without dividends. So you even can add dividends. And you have to convince them by arguing, well, if you believe that we will stay in a market economy, if we are not falling back into communism, equity capital always has to yield more than fixed income. Because if it would be the other way around, then nobody would open a corporation. And as long as we are in a market system, it's system immanent that equity capital is outperforming fixed income. That is right over time. There is no 20-year period in the US which was yielding negative. There are 2 10-year periods where you had slight negative returns. But if you are a longer term investment, there is hardly any risk. You just have to be able, and that's the difficult one, to stand by your guns when the markets look shaky. That's the real challenge, to invest and not selling your investment when something is happening like Corona, like Brexit, like Fukushima, or the financial crisis. That's the magic trick. Stand to your gun. And that's the reason why we always argue, go on holidays as long as possible. And absolutely no go during the holidays is reading any newspaper, because that only can generate emotions which are leading to selling your good quality portfolio at the wrong time. It's just common sense. We should train our people during their school times about capital markets. They learn everything about arithmetics, foreign languages, the old Greeks, religions maybe, but they have no clue about how to invest their hard-earned money. That's really a scandal, that we prepare our young people for earning money, but not for how to invest it. And that obviously is a window of opportunity for all good salespeople promoting their more or less qualified products.
One macro question: how long can the world continue to operate with near zero interest rates?
Well, to eternity. To eternity. And all the government bonds will end at the balance sheet of the central banks. Mm-hmm. Credit is nil. Look at the 10-year yield of Italian government bonds. It's below 0.8%. It's ridiculous if you just look at the risk of the Italian government and the Italian balance sheet. But as long as the ECB is just accepting every printed government debt as collateral for their balance sheet, and no people in the main street in Ljubljana revolts to that, and I think hardly any is doing that, this is going to continue. It's as I tried to make clear in my speech, it's right now a debate in the financial elite, but not one in the public. The public still believes that politicians are doing something great by producing all the rescue packages. If it only would have been rescue packages for Corona, then would argue, well, that's very temporary. But the politicians around the globe are on steroids, and you can't take them the zero interest rate away. That would kill their business models.
Yeah, but what can be the long-term damage of the potential moral hazard to a real economy?
It's ending up as a K-shaped development. People who realize that they have to protect from this with real assets will relatively outperform those who are so nervous that they don't do an investment which is necessary to be done. It's not about rich or poor, which is always mentioned in the media. It's about the one with courage and the one without courage. The loser will be the nervous one. The winner will be the one with decent nerves. And that's clearly going to develop in an even more widening scissor of wealth. And sooner or later, this is end up in a political crisis. But tell me when, I have no clue.
Is investing in real estate something for individual investors to count on long term?
I always argue owning your own home is essential. Everything else is business and not investing. If you are owning houses to rent off, that's business. That's like being a butcher. It's a lot of work. It's a lot of hustle. It's a lot of nightmare calls at Saturday night. The toilet flush is corrupt. Yes, if you want to be a businessman in real estate, this is great. If you are able to add value here, then this is a possibility. But for me, that is not investing.
Mr. Vorndran, thank you so much for this fascinating talk.
Pleasure.
It's always great to talk with you and to listen to you. And I hope we talk again soon. And thank you so much.
Christian, Domen,
thank you.
Bye-bye.